Every generation believes its money is different, safer, smarter, better managed than the money of its parents, and every generation is eventually taught, in the same expensive classroom otherwise. Consider a number so simple that a child could compute it, and so unforgiving that fortunes have been made and lost on either side of what it implies. Divide the Dow Jones Industrial Average by the price of a single troy ounce of gold. What emerges is not an abstraction. It is an exchange rate between paper ambition and physical patience, and it has been rendering its verdicts for more than a century with the impartiality of a tide table, indifferent to press releases, elections, or the reassurances of central bankers. At this moment, with the Dow hovering near 52,700 and gold trading in the neighborhood of $4,050 to $470 an ounce, that ratio sits at roughly 13. 13 ounces of gold today will still purchase 1 unit of America's most storied stock index. It is a figure that invites complacency precisely because it sounds unremarkable. It is not unremarkable. It is a waypoint on a road history has traveled before, and the road has a habit of ending somewhere that surprises nearly everyone still standing at this particular milepost. Before we wrap up, if you're serious about mastering the silver market, I have something special for you. Yesterday, I launched my brand new ebook, Silver Trading Mastery, and over 500 copies have already flown off the shelves. This guide takes you from complete beginner to expert trader, covering everything from professional market analysis to risk management. Think of this as a one-time investment that unlocks lifetime access to our private Telegram and WhatsApp communities for free guidance. If you want to trade with confidence while supporting the channel, click the link in the description below to buy your copy now. Rewind to 1999. The fever dream of the dot-com mania, when euphoria had convinced otherwise sober people that profits were an old-fashioned inconvenience. The ratio then stood near 43 ounces of gold for a single unit of the Dow, paper triumphant, metal an afterthought fit only for cranks and grandmothers. Rewind further to the stagflationary trough of 1980, when double-digit inflation had humiliated a decade of economists, and the ratio had compressed to something close to parity, roughly 1 ounce of gold for 1 unit of the Dow. The stock market, priced honestly in the one currency that has never defaulted on itself, had been reduced to a rounding error. Before we go further, and there is considerably further to go, tell me in the comments where in the world you're watching this from, and whether what is currently in your hand or your portfolio is paper or metal. This channel has become a genuine gathering place for people asking the same uncomfortable questions about money, and I would like to know who is in the room tonight. Now to the present tense, where the arithmetic turns genuinely interesting. The Federal Reserve's broadest measure of the money supply, known as M2, crossed $23 trillion for the first time in its history this spring, closing May at roughly $23.1 trillion, after a single-month increase of nearly $248 billion, the sharpest monthly expansion in 5 years. Since January alone, the aggregate has grown by close to $700 billion. That is not seasonal noise, and it is not a rounding adjustment. That is a central bank creating dollars at a pace that, on the historical record, tends to announce itself in consumer prices somewhere between 6 and 18 months later. The grocery bill is always the last line item to know. Asset markets, gold and silver prominent among them, generally hear the news first, and they have been listening closely. It would be a comfort, of a sort, to believe this expansion occurred against a placid geopolitical backdrop. It has not. The renewed confrontation between the United States and Iran, strikes traded in both directions, a naval blockade reimposed near the Strait of Hormuz, oil surging on fears for the roughly 1/5 of global crude traffic that transits those waters, has layered a fresh energy shock atop an already accelerating money supply. Gold and silver, whatever else may be said of them, have a long institutional memory for precisely this combination. Expanding currency, rising energy costs, and a great power uncertain of the price of its own resolve. It should not surprise anyone, then, that both metals spent 2025 at delivering the kind of returns that make prudent people faintly uncomfortable. Gold gained roughly 2/3 of its value over the year, its best annual performance since the Carter administration. Silver, characteristically the more excitable of the two, very nearly doubled, tearing through the once unthinkable $100 mark in January before both metals staged the kind of vigorous pullback that has accompanied every leg of this long bull market since it began. Gold touched a record above $500–600 an ounce at the end of January. Silver, not to be outdone, briefly traded above $121. Both have since surrendered a substantial share of those gains, gold now changing hands near $4,050 to $4,070, silver near $58 to $59, a pullback sharp enough to have convinced the tourists that the story is finished. The tourists are usually wrong at exactly this juncture. Bull markets and real assets do not conventionally expire in disappointment, while the central bank issuing the competing currency is actively expanding its supply. They tend instead to pause, shed the speculative froth accumulated at the top, and resume a pattern visible in nearly every secular cycle gold has produced since Washington severed the dollar's last tether to it in 1971. What makes the present configuration genuinely distinctive, and this deserves the fullest attention because it is the part institutional Washington would prefer remain a footnote, is the condition of the government issuing the currency in question. In 1980, when Paul Volcker crushed inflation by raising interest rates into the mid-teens and accepted a brutal recession as the toll for doing so, the federal government's debt stood at roughly 30% of the nation's economic output, a manageable, almost quaint burden by comparison with what has followed. Today, that ratio exceeds 120%. The Volcker solution, in other words, would today require an act of fiscal self-sacrifice that no democratically accountable government could survive at the ballot box. This is not a partisan observation. It is arithmetic, and arithmetic does not caucus, campaign, or apologize. There is a term economists borrow from psychology for the condition of mistaking the number printed on a currency for the value it actually commands. Money illusion. It afflicts entire societies, not merely careless individuals, and it is most dangerous precisely when a currency is being expanded fastest, because the nominal numbers, the account balances, the stock indices keep climbing even as the substance underneath them thins. The Dow at 52,700 feels like prosperity. Measured against the one asset that has outlasted every currency ever issued against it, it is closer to treading water. That leaves the current occupant of the Federal Reserve's chair with a considerably narrower set of tools than his most celebrated predecessor enjoyed, and precisely how narrow those tools are is the subject to which we turn next. The current occupant of the Federal Reserve's chair is Kevin Warsh, a man who arrived at the Mariner Eccles building with a reputation earned over years of public commentary before his appointment as a monetary hawk, someone who regarded the previous decade's tolerance for above-target inflation as an institutional embarrassment rather than an acceptable cost of doing business. He testified before Congress this month, and the data placed in front of him was, on its face, encouraging. The annual rate of inflation slowed to 3.5% in June, down from 4.2% in May, while prices on a monthly basis actually fell, the first such monthly decline since 2020. Mr. Warsh did not declare victory. He reiterated that the central bank has no tolerance for inflation that remains persistently elevated, and he has been notably candid, more candid than most of his recent predecessors, in acknowledging that the money supply itself, an aggregate the Fed spent much of the previous 2 decades treating as a historical curiosity rather than a live policy variable, deserves a renewed scrutiny, that the M2 aggregate has now reappeared, discussed rather than merely footnoted in the Fed's semi-annual report to Congress, is itself a modest vindication of the monetarist tradition, the old-fashioned conviction, unfashionable for years in central banking circles, that inflation is, at bottom, a monetary phenomenon caused by too much money chasing a relatively fixed supply of goods. The inflationary surge of 2021 and 2022 gave that tradition its most persuasive demonstration in a generation. The money supply data of 2026 suggests, at minimum, that the lesson has not been fully absorbed by the system that produced it. Here is the trap in which this leaves the Federal Reserve, stated plainly. Inflation has run above the Fed's own 2% target for 5 consecutive years, a stretch of time in which the purchasing power of ordinary savings has been eroded well beyond what the central bank itself professes to consider tolerable. The federal funds rate currently sits in a range of roughly 3.5 to 3.75%, a level that, in an earlier and less indebted era, would be considered modest by the standards of genuine inflation fighting. But a truly aggressive increase, a Volcker-style shock to the system, would collide immediately with the cost of servicing a national debt now approaching $40 trillion, a debt whose interest payments already consume an alarming share of federal revenue. Raise rates enough to break inflation's back, and you risk breaking the federal budget instead. The only tools that remain comfortably available to policymakers are the ones that, by their nature, continue to erode the real value of the dollar. This is not a failure of any particular official's character or competence. It is the structural consequence of decades of accumulated fiscal choices, arriving all at once at the same address, with the current chairman left to answer the door. If you have been following this channel for a while, watching, learning, quietly building your own understanding of what these numbers actually mean for your own household, this is the moment to make it official and subscribe. The conversation happening here, among people asking exactly these questions rather than waiting to be told the answers, is only going to matter more as this story develops over the months ahead, and I would rather you hear it from the beginning than come looking for it after the fact, once everyone else has already arrived at the conclusion you could have reached today. Which brings us to the dimension of this story that receives, by any fair accounting, almost no serious treatment in the conventional financial press, the quiet, methodical repositioning of the institutions that actually set global monetary policy at the sovereign level. Central banks, not retail investors chasing a chart, not hedge funds levering a momentum trade, but the reserve managers of nation states have been accumulating gold at a pace that would have seemed extraordinary as recently as 2021. Goldman Sachs now estimates that official sector purchases will average roughly 60 tons a month through 2026, more than triple the pace that prevailed before 2022, with the World Gold Council confirming that annual central bank buying has run close to 1,000 tons a year for 4 consecutive years running. A recent survey of reserve managers found that nearly half expect to add to their own gold holdings over the coming year, a striking figure for an asset that, within living professional memory, most portfolio managers considered a relic best left to numismatists. These are not gestures, and they are not symbolic diversification exercises undertaken for the appearance of prudence. A sovereign nation does not reallocate its reserves for decoration. It does so because it has concluded at the highest level of economic strategy that the promises embedded in another government's paper are less durable than they once appeared to be. When enough nations reach that conclusion at roughly the same time, the effect on price is not incidental. It is, in a very real sense, the entire mechanism at work. It is worth remembering that this is not the first time in living memory that the architecture of global reserves has been rebuilt. The Bretton Woods arrangement, which pegged the dollar to gold and every other major currency to the dollar, lasted barely a generation before Washington itself abandoned it in 1971, unable to make good on the convertibility it had promised the world. What followed was half a century in which the dollar, backed by nothing but the credibility of the government issuing it, nonetheless served as the world's reserve currency of choice, precisely because the alternatives seemed worse. What is unfolding now is the quiet reconsideration of that 50-year bargain, conducted not through treaties or communiques, but through the accumulated purchase orders of central banks that have simply stopped waiting for an announcement. To appreciate the scale of what could still be in motion, consider the relative size of the markets involved. The world's stock of above-ground gold at current prices is worth something in the neighborhood of $29 trillion, a genuinely enormous sum by any ordinary measure, and also a comparatively modest fraction of the roughly $140 trillion sitting in the global bond market. Institutions do not need to abandon bonds wholesale for gold to move dramatically higher. They need only reallocate a modest single-digit percentage of that pool, and the resulting flow of capital would rival the entire existing gold market in size. Price discovery under those conditions would not be gradual, and it would not be especially polite to anyone still positioned on the wrong side of it. There is a peculiarity in the current market that a historian of finance will find almost impossible to reconcile with reason, and it concerns not the metals themselves, but the companies that pull them from the ground. Silver's case is the more curious of the two because silver leads a double life that no other asset on Earth quite replicates. Something on the order of 60% of annual silver demand comes not from investors or central banks, but from industry, from the semiconductors, solar arrays, and data center infrastructure that constitute the physical skeleton of the artificial intelligence build-out, currently consuming hundreds of billions of dollars in capital expenditure each year. The same ounce a central bank might hold as a hedge against currency debasement is, quite literally, the same ounce a chip fabricator needs to complete a circuit. Mr. Warsh may speak, as central bankers are fond of doing, about the disinflationary promise of artificial intelligence. The physical silver required to build that intelligence's infrastructure still has to come from somewhere, and the deficit between what the world's mines produce and what the world consumes has now persisted for roughly half a decade running, with little relief in sight. And yet the entire global listed mining sector, every publicly traded company engaged in pulling gold and silver from the earth, combined remains valued in aggregate at a figure smaller than the market capitalization of a single prominent consumer electronics company. This is not a modest anomaly. It is the kind of valuation gap that, in almost any other sector, would already have attracted the attention of every activist investor on Wall Street. The commodity cycle, when it eventually asserts itself, rarely announces its arrival with a press release. It tends instead to arrive only once the absurdity of the mispricing has become too obvious for even the most complacent allocator to keep ignoring. None of this should be mistaken for a prediction, and the analysts making these calls are careful to say so themselves, even as their numbers grow more arresting by the quarter. J.P. Morgan currently projects gold reaching roughly $6,000 an ounce by the end of this year, with a path towards $6,300 by the close of 2027, built substantially on the expectation that central bank and private demand continue at their present elevated pace. Goldman Sachs, somewhat more conservatively, has reiterated a year-end target of $5,400. Bank of America has offered for silver the widest and most provocative range on Wall Street, somewhere between $135 and $309 an ounce, contingent on how far the gold-to-silver ratio, presently near 69 ounces of silver for a single ounce of gold, might eventually compress toward the historical extremes reached in 2011, or further back during the notorious Hunt Brothers cornering attempt of 1980. The bank is careful to frame its upper figure as a ceiling rather than a certainty, and other more measured forecasts on Wall Street cluster closer to the $85 to $100 range. Even the conservative case, though, represents a number that would have been dismissed as a punchline as recently as 3 years ago, and it is being issued not by a fringe newsletter but by one of the largest financial institutions on the planet. Sentiment among retail investors in the metal space, meanwhile, has fallen to levels this channel's own community has watched with something approaching disbelief, not because the underlying fundamentals have deteriorated, but because the sharp pullback from January's records shook loose exactly the participants who lacked the conviction or the historical perspective to hold through a correction of the sort every genuine bull market has produced at least once along the way. This is not, on the evidence, a signal to retreat. Bull markets, as a matter of historical record, do not conclude while sentiment remains. This depressed and institutional flows are still accelerating in the background. They conclude once the last skeptic has finally, reluctantly come around, and by any honest measure of current positioning, that moment has plainly not yet arrived. It is worth noting, in passing, that the Dow itself has spent this same stretch of 2026 setting one record after another, propelled less by the speculative technology names that dominated headlines in prior years than by a rotation into industrial and financial stalwarts benefiting from an extraordinary capital expenditure boom tied to the same artificial intelligence build-out that is quietly draining the world's silver stockpiles. That the index feels triumphant even as it becomes, on the honest reckoning of the gold ratio, cheaper in real terms rather than more expensive, is not a contradiction. It is precisely the illusion this entire conversation has been attempting to dispel. The Dow-to-Gold Ratio, recall, currently sits near 13, a full order of magnitude above where it bottomed in 1980, and further still from the near parity levels briefly touched during the Depression years of the early 1930s. Whether the eventual reversion arrives through a decline in the Dow, a further advance in gold, or some combination of the two, is a question history answers differently in each cycle. That some reversion eventually occurs is close to the nearest thing monetary history offers to a settled proposition. What is not in dispute is the direction of the forces now in motion. A money supply expanding at its fastest pace in 5 years, a sovereign debt burden that has foreclosed the traditional remedy for inflation, central banks purchasing gold at a rate unmatched in decades, and a mining sector priced as though none of it were actually happening. Whether you are already positioned for what these numbers suggest, or are only now beginning to take the question seriously, I would genuinely like to know. Leave a comment below and tell us where you stand, what you hold, why you hold it, and what, if anything, is still giving you pause. This channel exists for exactly that exchange, the kind of unhurried, historically literate conversation about money that the conventional financial press has neither the patience nor, frankly, the institutional incentive to have. Your comment is not a formality. It is the actual substance of what makes this community worth building, one informed voice at a time. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can